Every bull market feels invincible until it isn't. Prices are at all-time highs, influencers are calling for new targets every week, and then people who swore they'd never touch crypto are finally buying in. It looks like strength, but beneath the surface, something else is happening. This is the moment smart money waits for, the calm before the storm. Because when confidence peaks and euphoria takes over, that's when liquidity is deepest. That's when the biggest players start quietly exiting their positions. What most people don't realize is that markets rarely crash out of nowhere. They unwind slowly. The early sell-offs are masked by sharp rebounds that look bullish on the surface, while whales and institutions are transferring risk to latecomers who think the rally will never end. By the time retail traders start to notice, it's already too late. The top wasn't the spike, it was the silence that followed. Now in this video, we're going to break down how this process unfolds, how smart money sells without crashing the price, how the same playbook has repeated through every major cycle, and what clues to watch before it happens again. Because the truth is, every bull run eventually ends. The question is whether you'll recognize the signs when it does. Every bull market, whether it's stocks, real estate, or crypto, moves through 4 repeating phases. The names change, but the psychology stays the same. It starts with accumulation. This is when sentiment is at its lowest. Prices have already crashed, most people have given up, and smart money is quietly buying. Volume is thin, headlines are negative, and nobody's paying attention. Then comes the bull market. The crowd starts noticing. Adoption grows, confidence builds, and capital floods in. Prices rise faster than fundamentals, and suddenly everybody's an expert. This is when greed replaces logic and when distribution begins. The distribution phase is where the story changes. Smart money starts selling into strength while the public is still euphoric. The charts still look bullish, but momentum quietly fades. What looks like stability is actually controlled selling. And finally, the bear market. So prices collapse, liquidity disappears, and fear replaces greed. The same people who are shouting to the moon are now swearing off crypto entirely right before the next accumulation begins. These phases don't follow a schedule, but they always follow human emotion. And the most profitable investors are the ones who learn to spot the shift from euphoria to exhaustion before everyone else does. So the distribution phase is one of the most misunderstood parts of every bull market. Prices still look strong, social media is still euphoric, but behind the scenes, the biggest holders are already cashing out. Whales and institutions don't sell all at once. They sell strategically. They use multiple exchanges, over-the-counter desks, and algorithmic systems to spread their exits across time so they don't crash the price. The goal isn't panic, it's extraction. They offload to retail investors who are still buying the dip, convinced the rally will continue. But sometimes selling quietly isn't enough. That's where price manipulation comes in. Whales can create massive sell walls, visible orders on the order book that give the illusion of overwhelming supply. Retail traders see that wall, panic, and start selling. Once the price drops, the whales remove the fake wall and buy back cheaper. It's a simple, legal, psychological trick that plays on emotion rather than fundamentals. They can also trigger liquidations intentionally. A sudden dump in low liquidity hours, like on weekends, like what happened on October 10th, can wipe out leveraged traders, forcing automatic sell orders that push prices even lower. The whales then step in again, this time as buyers. These tactics have repeated in every cycle, from Mt. Gox in 2013 to the ICO era pumps in 2017 to institutional distribution in 2021. It's not manipulation for chaos, it's control. The biggest players use fear and excitement as tools to manage liquidity and keep profits predictable. So while most traders are watching price charts, smart money is watching behavior, because they know markets aren't just about numbers, they're about psychology, and distribution is where emotion becomes the product. If you just zoom out, every major Bitcoin cycle tells the same story: new technology, fresh optimism, and the same predictable exit by those who got in early. 2013 was Bitcoin's first real mania. Prices surged from under $100 to over $1,000 as Mt. Gox dominated the exchange landscape. Whales who had accumulated for years began offloading as the public flooded in. When the exchange failed under its own weight, the market collapsed 85%, and early holders quietly re-entered near the bottom. In 2017, the narrative shifted to ICOs, the promise of decentralized startups changing the world. Retail investors rushed in while smart money started distributing their tokens across dozens of exchanges. By December, as Bitcoin neared $20,000 and Ethereum touched $1,400, insiders were already selling. The crash that followed erased nearly 80% of a market value within a year. Then came 2021. The institutions arrived: ETFs, corporate treasuries, celebrity endorsements. For the first time, Bitcoin looked safe. But while retail investors were buying at $60,000, on-chain data showed long-term holders quietly reducing exposure. Exchange inflows rose sharply just weeks before the top. When momentum faded, those who bought the hype were left holding the bag. Different players, but same psychology. Each cycle introduces new narratives: halving, DeFi, AI, but the distribution phase never changes. It's the point where conviction turns into liquidity, and the crowd unknowingly buys the exit liquidity of those leaving first. The good news is that distribution leaves fingerprints. You just need to know where to look. The first sign is exchange inflows. When large wallets that have been dormant for months start sending Bitcoin to exchanges, it's often a clue that selling pressure is building. Whales don't transfer coins to sell immediately. They position them, waiting for liquidity at the highs. The second clue is volume divergence. Prices might still be rising, but if trading volume is declining, it means fewer buyers are supporting the move. That's a classic signal of exhaustion. Smart money is selling into the last wave of enthusiasm. Next, watch funding rates and open interest. When retail traders pile into leveraged longs, believing the rally is unstoppable, whales see it as an opportunity. They trigger sharp corrections to liquidate those positions, buying back from forced sellers at lower prices. And perhaps the most overlooked signal is sentiment. When every influencer is euphoric, when "this time is different" becomes the mantra, and when even cautious traders start abandoning risk management, that's not confidence, that's distribution. You won't spot every top perfectly, but you don't have to. The goal isn't to predict, it's to recognize when probabilities shift. When exchange inflows rise, volume drops, and sentiment peaks, it's time to stop chasing green candles and start protecting your profits. Because by the time the charts confirm the top, smart money has already left the building. Once you recognize the signs of distribution, the goal shifts from chasing gains to protecting them. This is where disciplined investors separate themselves from the crowd. The first rule is to take profits gradually. Don't try to time the absolute top. Instead, scale out of positions as price strength starts to fade. Selling in stages, 10 to 20% at a time, lets you secure profits without missing potential upside if momentum continues. Next, rotate into stronger assets. Bitcoin and select large caps usually hold value better than smaller altcoins when volatility rises. Converting part of your gains into stablecoins also helps preserve liquidity so you can re-enter when the market cools down. Third, reduce exposure to leverage, please. What looks like a small risk in a bull market becomes devastating in a downtrend. Lower your position sizes and avoid chasing short-term reversals because bear phases punish impatience. Fourth, keep custody of your funds. As exchange volumes drop and liquidity thins, counterparty risk rises. Moving assets to a hardware wallet gives you control no matter what happens to centralized platforms. Finally, use the quiet phases wisely. Study on-chain behavior. Backtest your strategies and stay connected to quality information instead of noise. Distribution phases can last months, but patience during these times often decide who survives the next cycle. Every market cycle rewards a different group of investors. The ones who thrive in bull markets aren't always the ones who survive the next phase. The key is understanding that distribution isn't a threat, it's a signal to shift your mindset. The market isn't turning against you, it's just changing hands. What feels like strength at the top is really the final stage of optimism before the reset. Recognizing that doesn't make you cynical, it makes you prepared. So please, take a step back, look at the bigger picture. The people who sold early in past cycles weren't lucky, they were disciplined. They understood that wealth in crypto isn't built by catching every top, but instead, it's built by protecting what's already been gained. If you start viewing distribution as opportunity instead of danger, you begin to trade like the smart money. You stop reacting emotionally and start acting intentionally. That's the mindset shift that turns volatility from a threat into an advantage. The next phase always comes, whether it's accumulation or decline, and those who stay rational through both are the ones who come out stronger when the cycle resets. If you want to learn how to protect your gains and position yourself for the next phase of the market, visit learningcrypto.com. You'll find clear strategies to help you navigate volatility with confidence, not emotion. Thanks so much for watching. I'll see you in the next video.